Ladies and gentlemen, thanks so much for tuning into The Scoop. You know me, I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we have one of our favorite friends of the show joining us on the other side of the mic, Josh Lim at Arbelos. This is your first time joining us in your new seat, in your new phone booth even. There's a lot happening in the markets, right? Obviously, in the wake of the election victory by President-elect Donald Trump, we've seen tailwind of liquidity across most of the crypto market. And, you know, we've been flirting with that $100,000 mark, which, you know, for folks who have been in this space, you know, between us, I think we're combined almost 15, 20 years. It's pretty spectacular to see. I want to start with the sort of macro trends that are underpinning this rally. You mentioned that we've moved from risk off markets in 2022 and risk is fully on. We flipped the script, as it were. Maybe we can start the program on elaborating about those specific macro shifts that are driving really this transition that we've seen.
Yeah. Well, first of all, thanks for having me back. I think by my count, this is maybe our third podcast together. So, I thought you would have been tired of me by now, but, and obviously the world has changed dramatically, I think, since the last time we spoke. It's interesting to see, right? Just how much the industry has changed and matured, and now has become mainstream to a global audience and played such a central part in the election in the U.S. I would say this. I think, the Trump election news was a game changer for our industry. It really opened up a lot of new avenues for our asset class to make its way into TradFi portfolios, right? And you could see, like, subsequent to the election, you've already had some very big movement in different parts of the crypto ecosystem, whether it's sort of these legacy tokens that are now more likely to get some sort of placement in TradFi portfolios via ETFs. You've seen a lot of willingness of people to take a look at DeFi protocols again, whether they're on ETH or Solana, basically things that are generating cash flows and could potentially get re-rated and under a Trump administration that is a little bit more friendly from a regulatory perspective. I think we've already seen that there's a lot more willingness to engage directly with the industry, whether it's like Brian Armstrong at Coinbase or the ETF issuers or even sort of trading firms, right, and hedge funds and asset managers that are allocating capital into the space. So yeah, very, very exciting time for all of us, and very busy, right? Everyone's sort of ramping up and hiring and spinning up new business lines and things like that.
From the position of a trading firm operating this space, what have flows and volumes look like? Do they mirror the uptick that we've seen on exchange platforms?
Yeah, I'd say, there's been a bifurcation, which is interesting to see, right? There is now, because of the ETF, we're living in this post-ETF world. I think the one thing your audience is probably already somewhat aware of, but needs to be more cognizant of, is that crypto is no longer an asset class in isolation. Like, it sits in a much broader spectrum of traditional asset classes, and it's one of many choices for asset managers to allocate into. And as a result, the ways that it trades, right, the market structure of crypto is changing rapidly. There's just more instruments to trade. There's more opportunities to create spreads and arbitrages between those different venues and products, and just the number of eyeballs, right, and the number of balance sheets, the amount of capital that can actually hold risk in Bitcoin Bitcoin and other crypto assets has grown dramatically. So I'd say, like, that's an important change in crypto in the last year and a half post FTX. I think that, the one thing that we've seen is that the driver, which used to be, let's say, more, things like Binance and Deribit and crypto native venues, a lot of the center of gravity has shifted towards things like CME, right? Like we saw going into the election, just massive prints, like very, very large buyers of call options on CME, resulting in new all-time highs in terms of open interest and volume on those exchanges on CME specifically, and that's really an indication of just traditional market players allocating into crypto, making a bet on crypto as the best sort of risk proxy for a Trump win. Obviously, that played out extremely well. I think a lot of the call buying was concentrated in like the 70, the 85K strikes. So it didn't take that much, in terms of post-election move to really reach those strikes. The break even was probably closer to like 80K. So those calls went deep in the money very quickly. I'd say CME is certainly one big beneficiary. That's the Chicago Mercantile Exchange for those of your audience that aren't steeped in the trading world. But there's also the IBIT options, which was recently approved by the CFTC. So that was another big change, post election. Probably one of a number of different sort of microscopic regulatory shifts that kind of add up to like a very large shift in market structure. But the approval of that obviously created another avenue for TradFi people to start allocating into crypto options, trade derivatives on crypto. And the IBA options, obviously exploded in volumes on day one, several $1 billion notional traded. And that was a day one notional that is comparable in size to what trades every single day on Deribit, which has existed for years, right? Like 5 or 6 years. And so it's amazing just how much more capital, right, is now being able to touch and trade crypto versus what was the case a year ago. So it's something you can't ignore. And I'm sure we'll talk a little bit more about this on this podcast, but there is this sort of element in the room around MicroStrategy and that stock and how it becomes a very accessible proxy for crypto, almost like a levered instrument on crypto, which itself has a number of levered instruments trading on it, ranging from the single name levered ETFs on MicroStrategy to options, which also trade on MicroStrategy, and just the sheer amount of volume that's trading on that these days. So yeah, it's an amazing kind of sea change in the way that people touch crypto.
The more sophisticated institutional market participants have a lot more degen bows in their quiver at their disposal than they did in previous cycles. So there's a lot of interesting things that you touched on in that question, one of which is sort of how the flow dynamics change, where the center of gravity is, sort of moving towards a platform like CME versus some more crypto native venues. You mentioned something interesting, which is that there are new opportunities that stem from this new market structure, new arbitrages. When folks think back to 2018 to 2020, the name of the game, right, was cross-exchange arbitrage, where you saw in certain markets, Bitcoin trading at a higher print than others as a result of myriad of factors, including like capital controls and such. You say there's new arbitrages. If that was the arbitrage play back in the day, what is it? What is it now? And I'm surprised that the sort of entrance of more institutional capital isn't actually decreasing the numbers of market inefficiencies. You're saying they're kind of been opening up.
Yeah, I mean, I guess it's a migration of opportunity, right? Because that last cycle, the opportunity set was really around like high frequency trading in the spot space and correlated linear instruments, right? Like futures and perpetual swaps versus spot. And if you were good at it, right, of course, a number of like Chicago-based prop trading firms and the like were very good at it. And you can very quickly extract money from the proliferation of just different spot and derivatives exchanges in crypto on linear instruments. Just you buy something, you sell something, it's kind of perfectly hedged. Nowadays, it's sort of migrated beyond just that simple buy something, sell something, or to some things that are like correlated loosely, and maybe have some other embedded like second order risks, right? So like options, right? Trading one option against another option. And like I said, the venues on which you can do this on, have multiplied. There's now beyond just Deribit, there's obviously the other crypto native exchanges like OKX and Binance. There's a number of smaller upstart exchanges that are trying to break into this market, like CoinCall and PowerTrade and a number of others. There's the DeFi native exchanges. Like these are guys that exist on chain, and obviously everyone's heard of Hyperliquid as the big sort of perp marketplace, but there's a number of option venues as well that have run order books on chain. And then in the sort of like traditional space, we already mentioned CME. There's going to be IBIT options. There's a whole host of correlated products like IBIT, like Coinbase equity, MicroStrategy equity. These all are names that have options listed on them. There's also a number of ETFs, right? There's the BITO ETF that isn't holding spot, but it's in fact holding a rolling futures strategy. So that's sort of correlated, but it's got a little bit of hair on it. And these are all things that, traditional bank trading desks or, these sort of like ETF ARB type shops like Jane Street and Citadel and others are very, very good at trading. So yeah, definitely that's kind of where the edge has migrated to, trading these more complex instruments and sort of like access products against the underlying asset, Bitcoin itself.
That makes a lot of sense. The opportunities of previous cycles were tied to the fact that, crypto is super fragmented and has all these different exchanges between which you can, capitalize on different ARBs. But now it's really, we have more products than we've ever had before and more names than we've ever had before tied to this space. Obviously ETFs being sort of the kingpin, as it were. We've had we had a trading firm on the show, Flowdesk, a few months ago. Or no, it was even longer than that.
Reed, right?
Yeah, we had Reed on. It was at the beginning of the year when the ETFs came online, and they outlined this thesis or this sort of framework to think about how this stream of flows coming from the ETFs, unlike a multi, I think they said multi-decade, if not multi-year, TWAP of buy only from these institutions. What do those flows? How do they? Something we talked about before we turn on the mics. How do they translate or sort of seep into broader crypto? How do they leak back right into the more speculative parts of crypto? Another way of asking the question is, more as a specific example, should listeners expect like good ETF flows to mean my meme coin bags are going to pump?
Yeah. So much has been, much ink has been spilled around just thinking about crypto as a macro economy, right? And almost thinking of different blockchains as countries, and how capital flows between different blockchains represent sort of trade and commerce between countries and things like that, right? And balance of payments. I think a similar thing is happening, right, with the creation of these ETF products, and then the sort of like smashing together of TradFi marketplaces and allocators and capital versus the amount of money and capital that grew up kind of natively in crypto, which we typically call that crypto native, right? Like asset managers and capital and trading shops. And in a lot of ways, this is like a clash of cycles and like a generational clash, right? So like last cycle, you had players dominated. The market was dominated by players that were crypto native, right? Like the set of hedge funds that were trading were firms that started as like $10 to $20 million hedge funds in crypto, but quickly grew to be like billion-dollar hedge funds that only traded crypto and crypto assets. The service providers were these crypto native prime brokers and lenders and trading firms, which obviously a lot of those received a culling post FTX last cycle, right? And now this cycle, the dominant players are like the BlackRocks and the banks and the traditional market makers. And not to say that those guys weren't present last cycle, but I would say they were doing a much simpler set of strategies versus now. I think people are, the TradFi players are kind of in their element, right? Like it's sort of, they are doing the things that they've done in every other asset class, like commodities and FX and everything else, and they're just putting it on crypto. So I would say, I would say there's been this question of just like, okay, the money is coming into crypto through the ETF, right? And it's primarily occurring to Bitcoin. How does that circulate? Does that actually transmit to other parts of the ecosystem? And it's been tough, right? Because like once that money goes into the Bitcoin ETF today, it sits in custody, right? Like Coinbase custody or some other custodian. And the capital that was used to buy it is generally unlevered capital. It's hard to borrow against those ETF holdings. So it's capital that's largely like sitting there, and it's fine when Bitcoin is going up, 10% a week. But once that subsides, it's like where does the capital stick around? Does it stay there? And you can kind of see like last couple of days with Bitcoin bumping against 100K, you start to see outflows in the ETF. It's all a little bit reflexive, right? But does that capital flow back into other assets within crypto, like the crypto native world, right? Does it become on-chain assets that is deployable into like TVL? Does it interact with crypto native players like the dealers and the lending shops and the prime brokers? And I think the answer is like no for now, because it's sort of like self-contained in that ETF box.
Well, is the way to think about it is the folks that are buying and holding spot ETFs are not going to be the same folks that are going to park, a bunch of money into a protocol like Athena or something. Like it's just different.
Right.
They're totally different profiles.
Yes and no, though. I mean, if you look
aside
at
from you, if you have spot ETFs in your 401k, and then obviously pumping, but I think you're an unusual character in that respect.
Yeah. I mean, yes, it's a different cast of characters for sure, and that's part of it, right? There's a disconnect between like supply and demand in the crypto native world and the TradFi world, and those players sometimes don't talk to each other. And the beneficiaries of that, by the way, are like the firms that do touch both realms, right? Like firms that have a CME clearing account and also run like a Deribit trading account, right? Or firms that can trade on Binance as well as trade on like Coinbase and Kraken, and can touch like IBIT and do creations and redemptions and things like that. So I mean, I think to answer your question like specifically, right? I think there is this lack of transmission right now from the ETF box to everything else in crypto, and that's why when you look at some of these altcoin rallies or the meme coin rallies and these sort of like very rapid rotations, these micro rotations happening today, I think it's like mostly just hot money flowing within crypto itself, right? There is a general wealth effect within crypto from the crypto native community, from the uplift in Bitcoin, which then transmits down like the whole kind of market cap table, right? Through, well, less so through ETH, but I guess through Solana and through other things these days. And then the Solana obviously gets recycled very, very effectively because it's got this whole infrastructure around speculation, from everything from like pump.fun to Jupiter and the whole infrastructure of trading on Solana. Then it kind of goes down to other L1s, right? So like for we've seen sort of the proliferation of like the legacy L1s that are benefiting from inflows. I would say mostly from probably rotation on like Binance perps and things like that, right? People have assets now and collateral now that is worth a lot more, and they're able to kind of like put that back to work in perps on these sort of tokens that are speculated to be upcoming candidates for ETFs and other things, right? So that's kind of where it's happening. I don't necessarily think it's like TradFi money that is making its way to the more speculative sectors of crypto. But I mean, that is sort of like, that will happen, right? It's question is just like, when does it happen and how does it happen? I mean, the biggest thing is just, can people take the capital that's in the ETF, leave it there, but still sort of like recycle it in some way, generate, like borrow against it? Or when do these instruments become like marginable, basically? And then if it is marginable, if you can borrow dollars against your IBIT holdings, right? Where do those dollars go? Do they sit in and stay in a brokerage account, or does it get taken out, converted to USDT, USDC, and then like plowed back into crypto in some way? So those are all questions that we have to kind of wait and see what happens.
That makes a lot of sense. So what does this sort of, I mean, last cycle we had the benefit of being able to check on those quarterly updates from your former employer, Genesis, on what the state of credit looked like. And it was a good proxy, since it was the largest player, to know how fast the pace at which the lending market was growing and the size and scale of the lending market for crypto. We don't really have that anymore, unfortunately. We can look at Galaxy's and Coinbase's earnings, but my understanding is that they're a smaller component of sort of credit in this market. So I guess, I don't know, I'm sure it's very interesting to you. What are those proxies for credit now? We've seen Aave increase quite a bit. What are the proxies, and what is the state? As I mentioned, we saw Novaretz mention that crypto was sort of levered to the gills, as it were. How can you even draw a conclusion like that in this market without a benchmark?
Yeah. And, there's multiple forms of leverage, right? I think last cycle, a lot of it was explicit leverage against borrowing against crypto assets. And that was all largely contained in the crypto native sector. Nowadays, I think when people talk about leverage embedded in crypto, it's probably a function of just open interest, right, on perpetuals, which is now at all time highs, and that is a function of like stock of spot price also being at all time highs, and just the open set of open positions is grown as a result. Also, I think as a result of people's collateral being worth more and being able to add more risk to their personal positions, PAs, basically. I do think that you have seen that, and you have seen like a good indication is just like the funding rates do run a little hotter these days, right? It's 10, 20, 30% per annum sometimes. It was that high last week, as we kind of were bumping up against 100K on Bitcoin. So that's one form of leverage in the system. You've got something like $50 billion of OI basically across the board. The other form of leverage is really now coming from the traditional market instruments that exist. So one implicit form of leverage is like MicroStrategy stock itself, right? Like you're talking about like an $80 billion company that's holding $30 billion of plus or minus $30 billion of Bitcoin, right? Kind of changes every day based on the price of Bitcoin, and also like the voracious appetite of Mr. Saylor. But that is a form of leverage, and it does trade on a beta, because it's sort of like there's some stability to that NAV premium that MicroStrategy stock has to its underlying Bitcoin assets. And then, of course, there's a host of derivatives and sort of like levered instruments on MicroStrategy itself. There's like the ETFs, like I mentioned, that have embedded convexity on MicroStrategy, meaning like it's some levered ratio on the underlying stock, so it has to buy and sell the stock as the price goes up and down. So it's sort of like being short optionality, having that instrument in the market, and you have options on it listed as well. You've got options on IBIT, So now it's all of this stuff is starting to emerge, and you've got the CME products as well, right? So all of this stuff is emerging at the same time that there's a all-time highs in open interest on the crypto native side of things. So yeah, it does feel like there's leverage.
I wonder what MicroStrategy's LTM leverage ratio is.
In terms of just like their cap structure leverage ratio.
Yeah.
Well, I think they have maybe call it $10 billion of debt outstanding after the latest issuance. And they're holding $30 to $35 billion of Bitcoin, right? So yeah, I think a lot of people watch MicroStrategy as a potential source of risk for the entire crypto ecosystem, systemic risk, right? But it's really not. Like there isn't really that lever where they can get liquidated, right? They issued bonds, and those bonds are fairly long dated, and Bitcoin has to go down 70% before even their net asset value is below the value of the bond notional issued. So it's tough, right? It's tough to see a situation where they get in trouble. Now, like where it could go bad is for people who are buying and holding the asset or the stock or the convertible bonds without really understanding the dynamics at play, like the fact that it does trade at a premium to the NAV, and there's a lot of leverage that comes from that, and the fact that there's a compressive force too on the NAV over time, right? Like the more stock gets issued, and then the proceeds of that issuance being used to buy more Bitcoin, the less of a premium it should trade at over time. And also, obviously, like the more stock you issue, the more convertible bonds you issue, the more you saturate the market demand for exposure. So, it seems pretty early, I guess. There's like still a lot of, if you think about the universe of asset managers that want exposure to Bitcoin, and the limited set of instruments available to them, right? MicroStrategy being one of them. Like you kind of think there's probably a lot more appetite to go before he saturates the market. But it's something people need to be aware of, because like if you're a retail investor, you're holding it, it's going to be a volatile ride. And if you do it on leverage, then things can go bad before even if Bitcoin goes to like 200K, right? You might get stopped out before then.
Yeah, it's a risky. For the individual trader, it's a much more risky endeavor than for Mr. Sailor, frankly. But yeah, that's the what's the old saying? There's three things that can kill a man: liquor, leverage, and love.
Yeah, it's true.
When you think about what if we look into the next 6 to 12 months from your perspective, product wise or just market structure wise, what do you think will drive the narrative? What do you think is going to underpin the next 6 to 12 months?
Sure. Yeah, I think part of it is this sort of continued bifurcation, right, between like the TradFi market structure and crypto market structure, and who sits in between and is able to intermediate flows between those two worlds. And what are the projects and companies building in that sort of bridging that chasm? There's a number of things, right? There's sort of these on-chain protocols that try to sort of provide a bridge between CeFi and DeFi, and some of them are wrapping up like things like the basis trade, right? They sort of tokenize the basis trade and then allow that to be used as collateral on crypto native venues, whether it's a DEX or on a centralized exchange. And there's going to be more of that and more varieties of that. Like the underlying asset behind those types of collateral products could be tokenized T-bills as well, right? They could be like the BlackRock build product, which is basically like a tokenized T-bill. Or it could be this sort of more complex instrument like the basis trade constructed using Bitcoin and perps on Binance, let's say, right? So that's interesting, and that's a way to sort of like bridge the gap. I think it's becoming much more fluid in terms of like if you're a TradFi player and you want to touch crypto, there's so many different ways now to do it. You probably can go through like a dealer, like a swap dealer or a broker dealer and get access to crypto that way, or you can I think it's becoming clear that the crypto native players are wanting to get more regulated, and there's a clear pathway for them to get regulated. And so now maybe if you're a regulated hedge fund, you can start accessing directly on those venues like Deribit and Coinbase International, these types of derivative exchanges. So I think that's like a big open question. Where does the intersection of TradFi and crypto evolve to? I think another big trend is, as we get from this stage where crypto is like up only to like mid to late cycle, right? What are the set of products that people are going to move into? And if last cycle was a template, it would be into yield bearing products. You're now holding something that is worth 5 or 10x more than when you put money into it. Now maybe you want to protect your downside, right? So maybe you want to de-risk a little bit and turn it into more of a yield bearing play. Like that might involve selling options against it, like overriding it, or it might be using that asset to borrow and maybe collaring that asset, like buying puts on it and selling calls on that asset to get something more of a stable value, and then extracting some sort of yield from that. I think that is a natural part of the cycle too. It just happens every time you reach a new plateau. And now there's so much more capital, right? In this asset class, it's, $3-4 trillion asset class now. So, there's going to be service providers for that. I think that's going to be another big theme, is just which companies have survived all these different crazy cycles in crypto and who are going to be the dominant winners, who are going to be the kind of household brand names that people turn to provide all of these services, whether it's trading or lending or custody. And obviously there's going to be a lot of consolidation happening. Like people are going to narrow the set of firms that they touch and trade with. And then, counterparty credit risk always rears its head in that mid to late cycle part of the cycle. So yeah,
we've seen it before. Yeah. I'm sure we'll see it again. You just got to be quick.
Exactly.
Or cheat. You can cheat too, but I never cheat. What's from a margin call? No, but one thing that's interesting about, to your point, just the fact that the regulatory tone shift opens the door to new participants entering the market. I mean, we've seen, I think it was the CEO of Charles Schwab basically say, hey, we were wrong. We need to be in this, and effectively eating crow in the approach that the firm had taken up until that point. But I've heard, banks, which, since we've been in this space, I know you came from, UBS. A lot of these firms just couldn't touch crypto, even the ones that, make the splashy announcements on the other side of it. Right? I think there was one bank I was talking to, or a former executive at the bank, who said they couldn't even open up a wallet just to test trades or do, very exploratory, rudimentary things in crypto with an admin that's favorable to it, with an admin that can say, yes, you can touch this. They can't have that excuse anymore. That's been the excuse for the last decade is, well, we can't touch crypto. We're not allowed to. If they're literally allowed to, then this is any bank that doesn't get into crypto in this new era is really doing it. They can't use that as their cover anymore, right. Which is a big shift.
Yeah, totally. I mean, I think it's gotten to the point where people are forced to respond, right, to shareholders and the board and things like that on how to get, if Trump is talking about putting creating a Bitcoin strategic reserve, like, how can that be the case? And, our firm, our trading shop doesn't have a strategy around this and isn't able to touch these assets natively. And yeah, I mean, it's also just like the ease of which you can do it, whether it's through these sort of like on ramps or through through the ETF. It simplifies it so dramatically that it's hard to argue that there are no access vehicles appropriate for a regulated entity.
You have no excuse anymore. All you bankers listening to the show, get to work.
Right.
Well, Josh, thanks so much for taking the time. I hope you have a nice Thanksgiving.
Yeah, thanks for having me back on.
Of course. Thank you.